right, good morning, everyone. Today is May 11th, 2022, and I'm back with another edition of the Wednesday live show, which I know a lot of you guys watch on replay, and the replay is always posted on the live show page shortly after the show ends so that you can watch it at your convenience. And boy, a lot has transpired since last time I did the show. As I recall, last week was the Fed announcement coming up, and they did, as expected, they raised the Fed funds rate by half a point, and and it's been kind of a wild ride ever since then. And of course, this morning the CPI numbers came out, and obviously the Fed is embarked on a rate hiking cycle to fight inflation, which is running at, it's 8.3%. And I believe the last CPI print was 8.5%. So it hasn't really slowed down. And so obviously inflation is the main subject that everyone's talking about now. And boy, the Fed's really painted themselves in a corner, because it's hard to fight 8% inflation with not even 1% Fed funds rate. So anyway, the expectations going into today were that they were going to raise another half a point in at the May meeting and the June meeting, something like that. I don't know, or maybe it's not the June and July meetings. Probably raise half a point. So, and then of course there will be conjecture about whether they're prepared to be more aggressive, but keep this in mind. I mean, you know what the market's been doing. Everybody knows that the market's been on a wild roller coaster ride, mostly the downside, right? And keep in mind, they don't talk about this much, but when the Fed announcement came out last week, basically their plan is to start shrinking their balance sheet, shrinking their balance sheet starting on June 1st. So that's like 3 weeks from today, the Fed balance sheet starts to shrink. And the market's been CNBC did a markets in turmoil special back here a few days back, and I mean, you can see what's been happening here, obviously, and the majority, I wouldn't say the majority, but a large number of stocks have absolutely been crushed. I mean, the high flyers, the momentum stocks, it's it's worse than a bear market. It's just absolute devastation, and it reminds me a lot of back in the dot-com days, when you had all these crazy companies IPOing and companies that weren't profitable and a lot of hype and that type of thing. And I looked through a bunch of IPOs. FinViz has got a great screen for companies that went public in the last year. And man, if you look through those, you can see that you can just see a bunch of stuff I never heard of. Tons of software companies that I've never heard of went public and promptly proceeded to lose most of their value. So it's a real mess out there. This IPO, and I mean, typical Wall Street, strike while the iron is hot, or whatever that saying is. And so this is the IPO ETF. Interestingly enough, if you look through enough charts, you'll see a lot of tech stocks and high flyers peaked last year. They peaked prior to the market itself actually peaking. So, but then this is a pretty good picture of it. But you can see that and I'm not exactly sure whether how this ETF is constructed, but basically it's sort of a good representation of the typical IPO. And boy, it was, prior to the pandemic, it was hitting a new high, right? Obviously, there's the pandemic sell-off. So prior to the pandemic, I mean, it was on a tear, and there was tons of companies IPOing, and a lot of questionable companies took the opportunity to IPO in such a hot market. And the other thing is that, um, this really took off after the pandemic sell-off. Really took off. And so, for some reason I'm receiving a error message from YouTube. So hopefully this is recording okay. The live show may get glitchy, but the recording should be okay. Anyway, this just, if you look at where it is now compared to, it's lower than, it's back down to this pandemic sell-off, really. It's a mess. So, here's an example. Today they're talking about Coinbase, right? So, because Coinbase absolutely destroyed. So, it looks like the IPO, like the people that were able to get in pre-IPO, right? See, that used to be the big thing, is that brokers would let their best clients like get in at the actual IPO price, which on this you can just barely see that little dot there, but I believe $250 on Coinbase, and then this big spike here is what it started trading at after market. And then you can see, it was kind of a wild sell-off down initially, and then it kind of rallied back up here to this area. But I mean, look at where it is now. See, um, and there's just tons and tons of cases like this, but this is one of the big ones. So Robinhood, similar type thing, right? Tons of hype surrounding this IPO, but so anyway, you can kind of see, just those are a couple of good examples. But my point here is from my experience back in the dot-com days, the post 2000 Nasdaq sell-off, is that a lot of these stocks, they'll never recover. I mean, some of them will, some of them may, but a lot of these stocks that are down, 70, 80%, they may never ever recover. See it all the time. You can go back and look at monthly charts, and you'll see stocks that still have never exceeded their high in 2000, like GE. GE is a good example. Back in the dot-com days, GE was one of the blue chips, or whatever they called them. You don't hear that term used very much lately, but anyway, here's one on my watch list, that this Roblox or whatever. This was a pretty hot IPO, and you can see that, basically you can see the whole trading history here. And so, you have to look at the highs on some of these things in order for a stock like this to battle its way back up. Is quite a challenge. I mean, obviously this thing could bounce, probably double from here, but to get back to the high is going to be an extreme challenge. So who knows? But anyway, losing my train of thought here because there's a dog outside barking. It's very annoying. So anyway, the S&P, was down like about 15%. Oh, by the way, we're actually getting a little bounce here today. It was a crazy morning. The futures, like as soon as the CPI numbers came out, the futures dropped literally like 100 points off the high in about 10 minutes. It was something to see. It was absolutely incredible. Futures just plunged, and it was pretty amazing. And so now, here's the thing, is like for the past several weeks, let's look at a weekly chart here. This is like probably this is the third week in a row everyone was expecting a relief rally. And so, today, this week, yeah, maybe we do get a relief rally. But, the week, I remember, like, I think it was like, after this week, which was really nasty, the following week, I mean, the conventional wisdom really the conventional wisdom was that we were probably going to see some sort of an oversold rally, a relief rally, a bounce or whatever, and that didn't happen. And then the following week, same sort of thing. And so even this week, but the big thing about right now is going back to the SPX. The over and under now is 4,000. So we've had several probes, obviously, in the past few days below 4,000. Um, there's the thing about where we are now is that, yeah, pretty oversold, right? And this is what I wanted to point off. This sell-off right here, this sell-off basically started right here at about 4,500 when Jerome Powell was like it was like an economist club or something like that. It was on a Thursday, and he was speaking, and he was speaking really hawkishly, right? And the market looked like it was getting ready to sort of, break out of this little down channel and rally, and then his comments sent it tumbling that day. And basically, that was 500 S&P points ago. So that's an extreme sell-off in a very short amount of time. So it remains to be seen what happens from here. But I mean, even I'm gonna say, a rally up to 4,200, somewhere around these lows. I don't really want to draw on this chart, but you can look at like these lows, and so 4175 to 4,200 is going to present a lot of overhead resistance. Interestingly enough, this level right here, these three green candles sticking up here right at about 4,300, that's a 300 S&P points up from here, which is considerable, and that's a huge point of resistance. So, but sentiment is terrible. The market's oversold. And so now you start zooming back on the chart, and there's a gap over here that got filled from last April. As of yesterday, the S&P was actually down year over year. The S&P, I don't think, reflects the sort of damage that's actually occurred already in the market. Obviously, there's a few big reference points on this chart. One is 4,000. I mean, you can see that there's a lot of support right at 4,000. So 4,000 was great on the way up, but the markets are in turmoil on the way down. So this is kind of a nasty looking top here, and I think that over the years, well, I know that over a long period of time, most participants have always seen a market that throws these little fits and then always eventually recovers and goes back up. But hey, we're sort of, and I'm weighing this in my own mind, we're sort of in a different environment now because of the fact that inflation is out of control, right? And so the Fed, and the funny thing is the Fed is blaming inflation on everything except for what really caused it, which was them, creating extraordinary amounts of money out of thin air, calling it QE and throwing it in the economy, because of the pandemic, obviously. So there were contributing factors, supply chains, the situation with Ukraine, all that kind of stuff, what's China lockdowns. I mean, there's on and on and on, but in reality, inflation, if you, and then I'm sure they study inflation. I don't know what they thought was going to happen, but all throughout history, when you water down the money supply with more money, what the result is inflation. And they pretended, or they thought that all their aggressive monetary policy wasn't going to result in inflation. And boy, were they wrong. And so now it's up to them to do whatever it takes. So anyways, raising interest rates, reducing the balance sheet, this and that. Basically, the cure for the inflation is a recession. They keep talking about a soft landing, and it's a mess. So anyway, I would expect somewhere I got a chart. Somewhere I got a chart here that I might as well just redraw it on this chart. You know, I've been talking about this for quite some time, but there's that major overhead trend line. That's a long way up. I mean, obviously the market's not going to rally up to that level anytime soon. I don't even know, I don't even know how to draw. I suppose, a parallel line or something like that probably makes a little bit of sense to give us an idea where we are. So, yeah, quite frankly, I could also draw another, let's see. Yeah, there you go. Big, there's resistance there, resistance there. Whoops. That's what I hate about these things. Let me try that again. All right. All right, that looks reasonable. So anyway, very oversold, kind of what you could say is the bottom of a channel. I looked at a chart with Bollinger Bands on it, and we were poking out of the bottom. So the market's probably due for some sort of a bounce, and everybody's been saying that for a while now, of course, expecting a bounce. But eventually you do get a bounce from these sort of levels because you just do. And so, but the thing of it is that we're in sort of an environment now where instead of buying the dip, I believe that there's a lot of participants whose perception has changed that rallies are going to be an opportunity to lighten up or sell if they haven't already. I'm going to try and fix my chart here. There we go. So anyway, there's some levels to watch. Earnings season is kind of winding down. I had this big list of stocks that a whole bunch of them were getting ready to come out with earnings, and now as I look at it, basically the earnings are mostly out, so that's a positive sign. Oh, the other thing is that when you get these kind of sell-offs like we've seen, you get some humongous rallies. Take a look at a few of the stocks here, like for instance, some of the energy stocks are starting to look a little bit interesting because energy was obviously one of the leading sectors so far this year, and that's where a lot of the money's been hiding. And then, of course, as typical, the leading sectors eventually the market catches up to them, and you can see what's happened to some of these energy stocks. But quite frankly, some of them are starting to actually set up. So that'll be one of the areas that be looking at. Energy and materials. Let's see what XOP looks like here. Yeah, XOP's, I mean, this thing's volatile. Oh, but what I was about to say is that like you'll see stocks that are up double-digit percentages, and then you look at the chart and I mean, it's just been crushed so bad. See, a lot of what they call bear market rallies can be substantial, and you get these stocks that have been selling off, especially tech stocks, for a long time. And when they get bounces, I mean, it can be like crazy, like, double digit, 12, 15% in a day. This RBLX, here's the perfect example of what I'm talking about. This thing's up 17% right now today. But I mean, look at the chart, right? And so, hey, that's another thing. They come on CNBC and they're like, such and such is up 17% today, and you think that's exciting or whatever, and then you look at the chart and it's just a blip on the chart, right? So anyhow, we got a couple of pending trades. This JO is still, this is the price of coffee, and it's in like sort of the second phase of a pullback, right? The trigger line's still way up here. And here's the thing, it broke down below the 200. It's trying to recover it back now, and theoretically at some point, given enough time, this trigger line may actually come down, but as of the past week or so, it's still hanging up there. Kind of looked good, like maybe it was going to catch a bounce, form a W pattern, and it still could. So a lot of times there's sort of an extra shakeout that comes with these things. So the good thing about JO is that there's no earnings to worry about. It is a pretty gappy chart, though. That I will have to say. These gappy charts, sometimes I like to look at them as a line chart. Removes the gaps out of them, but still viable. I would say unless it breaks down below these recent lows here. If it starts to recover now, it could potentially. I wanted to look at. They were showing DBC commodity index. It's kind of an interesting chart. They were showing this, I believe, or talking about it on CNBC. So, there's your inflation right there. Commodities have just been on a tear basically since last fall, and a couple little minor pullbacks here, but still a lot of strength. Yeah, kind of interesting. Speaking of which, this particular stock hit the pending list, I believe, just this week, just recently here. That's a nice sort of sharp, relatively orderly sell down, and it's just looking pretty good. I mean, obviously yesterday it sort of sold. I believe earnings just came out a few days ago. We talked about this. This was one that hit the pending list ahead of earnings, and so I mean, in which case we just suppress it from the list. Once earnings came out, it didn't have a humongous gap up or gap down like a lot of other ones, and so now it's completely viable. Basically, what it needs to do here is it needs to churn around like here, form a base, and then begin to recover. So I was actually looking at some other commodity related stuff. There's XME ETF. You can see I'm not going to draw. Every time I try and draw a line on here, I have to rejigger my chart, so I'm not going to actually draw it on here. But if I do a horizontal line kind of across these highs right there, you'd see that basically there's, it's come down to a pretty substantial level of support. And so depending on what it does, if it bases out down here, it could begin to turn up too. Now let's see. Look at some material stocks. Yeah, a lot of them look like this, right? A lot of them look similar. Here's U.S. Steel. Huge run up, big sell down. So I would expect. Let's see, Freeport McMoran. Yeah, I would expect some of. And so energy and materials, I think, is probably going to be one of the sectors that has the most potential for swing trade setups going forward. That's what I'm sort of thinking. Here's another one, SQM. So I have a watch list with a handful of these on them. Let's see. Occidental Petroleum. That thing's actually been holding up really well. Barely a dip. Now let's see. Oh, some of these. There's a few. I have a couple of these lithium stocks on my watch list. This is kind of an interesting pattern. Man, this thing's volatile. I believe this just came out with earnings, but this is kind of shaping up, or was kind of shaping up for a swing trade too. The way it came down, started to cut back up, but extremely volatile here. So these are just some, these are just some ideas, some stuff on on my watch list that I think might be potentially worth watching. Energy and materials. So we have two pending trades now, and I would expect, here's the thing: the market itself, yeah, I mean, obviously, it's just, and a lot of stocks have just absolutely been destroyed. Let's take a look at ARK here. Excuse me. Yeah, see, there's almost no let up in the destruction in the momentum tech stocks. Although, hey, they're still due for another bounce. I think ARK's down today. I mean, it's, obviously it gapped down and is trying to push up. So, I mean, this thing could easily, rally. I wouldn't say easily, but, I would expect, you can see all the other rallies on here off of oversold conditions. And so this thing could bounce from 40 to 50 or whatever. But, I mean, as far as, this is gonna be. There were a few, I guess, poster childs for the dot-com meltdown, and a few people that they sort of cheerleaded it the whole way, and I'm pretty sure that, when the history books are written about this era, that this is going to be the poster child for this. And so, I mean, this thing's at $40. What's it gonna take for it to get back to the highs? Can it ever recover back to the highs? Good question. So, but as you can see here, and I've seen a few of these lately, a few of these tech stocks, this thing, if I drew a, well, I guess I can draw. I don't have to draw a level. I'll just use this little crosshairs. Look at where this is in relation to the pandemic sell-off. I mean, that tells you something. It's sitting, right at that level. And so, anyway, this is basically a glimpse at a vast majority of stocks, have had this kind of round trip, and it's ugly. I mean, it's bad. The destruction is amazing. So, I don't know what to say. I mean, that's why, for one thing, that's why we use stops. And it's interesting to me because, ARK publishes their buys and sells totally transparent on a daily basis. And the one thing that everybody notices, that I notice, everybody notices, they average down. They keep buying shares of these companies, and and so, their cost base, and they publish their cost basis, and the cost basis they have on some of these, they hold huge amounts of shares, huge positions with a cost basis that is just astronomical compared to the current prices. So I don't know how this is going to shake out, to be honest with you. The other weird thing is that there's this ETF, and I don't even know how this works, but I mean, it cuts both ways, right? I mean, this is no slam dunk anymore here, considering, the damage has been done. But so, somebody named Tuttle Capital came out with like an inverse ARK ETF, and as of since the IPO, this thing's been, so this is like this is like a shorting ARK ETF. It's a little scary looking because the market, these stocks they're so oversold, they're due for a bounce. So I don't know what to tell you. But anyway, back to the indexes, the Qs have taken a lot more heat than the S&P, and so you can see here, you see that support level. Look at that. Let me try and zoom back just a little bit more. It's amazing. It's amazing how this works, because this this like level of support you can see goes back to, kind of goes back to here, like last October, last fall, and so the Qs are sort of finding support right where they should. But I think what's so insidious about this is that bounce here back in March, and on the S&P too, like just a straight up rally for a few weeks there that took it over the prior highs, and like just barely over it. I think that that probably there was a lot of dip buyers and chasers, and I mean I don't know if that was a short covering rally or what, but I mean that just goes to show you, a bear market rally can really be a face ripper, right? But and then everybody thinks, oh man, the worst is over. I better get in now, somewhere around here, and then the next shoe drops. This is a really nasty chart too. Yeah, tons of resistance, probably from about 320 to 325 on the Qs, and so, but trying to stabilize, and that's just the nature of stocks in the markets. They move in one direction, and then they stabilize a little bit, and they make a counter trend move. But I mean the trend, obviously, the overall trend. This is one where you can draw a trend line down across the highs. So any way that you slice it, the trend is down, right? So I don't know what it's going to take. And this earnings season has been, I mean, I can't believe some of the percentage moves of stocks that have just been killed. They release earnings. There was one the other day. I can't. There's been so many, but comes out and they beat estimates, they beat their sales, they beat their revenue, they beat their estimates and all that, and the stock drops like 25-30%. So it's a brutal environment, and really brutal environment. And the best thing is this is the one earnings season that reminds us why we never hold a stock, for a swing trade over earnings. Whoops, make a typo. Look at Amazon here. Just I saw something about Fang. So is I don't know. They started off with like, was it Facebook, Apple, Netflix, and Google, right? And then they expanded it to FAANG, and then it was FAAMNG and all that. But yeah, Amazon's kind of interesting. Earnings gap down and then continuation. I mean, back in a more forgiving environment, a lot of times we'd see a stock drop on earnings, and then a couple days later it would basically like fill the gap and then go back up to where it came from. Boy, you can't. Netflix. This is a 2-year chart, I guess. Well, hang on. 19, 1 year, 2 years, 3. This is more than 2-year chart. Huh, some of these charts only go back 2 years daily, but I mean, look at that. Just epic disaster. Epic disaster. And so, hey, right, one of the FANG stocks. A lot of destruction happening in these hedge funds. Obviously, while the market majority of stocks have been getting destroyed, the hedge funds have been camping out in the mega cap stocks, several of which have really taken it on the chin. So probably the most important stocks to the market right now are Apple, which is holding support here. Apple's managing to hold support, and so it's sold down a little bit, but it hasn't broken down. And Microsoft, right? Microsoft, kind of an orderly sell down, and that's interesting. It's not a pretty picture, but I mean it's down relatively insignificantly, and Tesla. So Tesla, a lot of zigging and zagging. So I mean, a few of these charts, like to me, Apple sort of looks like sort of looks like it could potentially base out around here, and I could draw a trend line across those highs. So there, it likes to zig and zag, and so it zigged. Look at that straight up move, and now it's come back down here, and so at some point, we could get another move like that, but and I would say that as much as I hate to say it, the past few weeks here, like I said, everyone's been expecting a relief rally, and quite frankly, a relief rally, sometime over the next few weeks would be appropriate timing because think about it, on June 1st here, that's when the Fed starts shrinking its balance sheet, and so I don't know how that's going to obviously affect the market in the near term, but I know over the longer term that once they start pulling liquidity, right, then it's a whole different ballgame. I'm sure you've seen these charts where a long-term S&P compared to the Fed's balance sheet is like, it's highly correlated. And quite frankly, we've never been in an environment like this where inflation's out of control and interest rates are almost nothing, and the Fed's been, creating money out of thin air and expanded their balance sheet. Now they're going to shrink it into a slowing economy. We had a negative GDP print, so it's a real mess out there. So you got to be extremely cautious, and it is what it is. So, but within the context of the macro environment and the overall market, obviously there's going to be plenty of opportunities, although they've been few and far apart. The one thing I had, one of the members asked me about, said he'd been away for a while and asked me about, what was going on this year, and I said, well, basically, other than a couple of swings and a miss, small stop outs, we managed to avoid the entire sell-off that happened. Didn't really catch this bounce here. Actually, we caught it with a couple, but I think we might have had one or something. But basically, there has not been very much activity at all this year. But on a positive note, we've managed to sidestep all the carnage. So sometimes sitting on your hands is the right thing to do. So you see this a lot now, people posting on social media about how cash is a position and this and that. So, I mean, at least temporarily, right? Here's the question right now: was this the capitulation move? I mean, yesterday and the day before kind of felt like there was a little bit of fear, right? A little bit of fear, and let's see what the VIX looks like here. Yeah, the VIX is kind of well, here you go. VIX over 30 is a little bit of fear, but not the type of fear that you would expect, right? So did we see the capitulation move? Maybe. Maybe a near-term capitulation, maybe not. So the thing about it is the S&P did go below. It did go below 4,000, and so it almost seems like they're trying to whoever they may be is trying to defend 4,000, because every sort of poke below 4,000, there's a subsequent rally back above it. So anyway, now would probably be a decent time for, now that the news is out. See, that was the other thing, is that the much anticipated CPI release this morning was sort of the news event everybody was hinging on. And so now that the news is out, and even though it was a little bit worse than expected, at least that uncertainty is not hanging over everyone's head. And so now would be a decent time for a little bit of an oversold rally, but it will remain to be seen, how it can chew through some of this resistance, and it's a long way to go back up. So definitely not out of the woods, and I'll be keeping in the back of my head that the Fed is going to begin reducing its balance sheet on June 1st. So that's sort of the next thing to worry about. But anyway, we'll see. Everything on my screen is green today, right? JO, it's up 5% today. Big gap up. Huh. Interesting. This doesn't look like this doesn't match my Thinkorswim, which is kind of interesting, but maybe because it's an ETN or something, I don't know. But anyway, we'll keep an eye out for any new stocks that are pending, and if we do get an oversold rally, maybe we'll get something triggers in. So, hey, thanks for tuning in. I will see you back here same time next week.